Nothing says Miami like the beautiful sound of leaf blowers and that fresh smell of dust in the air. It's nice to be home. Now, the government has been doing things for a long time to make it easier for people to buy homes, especially people that can't really afford to buy homes. Well, now they're going to make it even easier for people who are essentially broke to be able to buy a home, guys. It's bad enough that we have programs available that's 1% down, 0% down, all of this stuff with a 620 credit score. But on top of that, FHA now, they're making it even easier for people to get loans that can't really afford the house. What they're trying to do is they're looking at changing the underwriting guidelines to make it even easier to include borrowers' rental income, okay? So now what they want to do is they want to increase flexibility by ending the life of loan requirement beyond what the Biden administration has already done. Here we have a house for sale for $2.25 million, which was purchased back in 2019 for only $582,000, and they've actually been trying to flip this house ever since 2020. They have been on and off listing this house for $1.5 million, and then back in 2021 they listed it again, took it off the market, and then back in April they put it back on the market for $2.25 million once again. It went under contract, then the deal fell apart, came back on, and here the house is again. And who knows how long this house has actually been empty. But this house behind me is a perfect example of why you can't just buy a house and fix and flip and think that you're just going to make all this money, guys. People have an idea in mind of what they're going to get for the house, and if they don't get it, then they sit on it. And some people can afford to do that, but most people who are trying to make money with a flip can't afford to do that. Anyways, going back to this new FHA underwriting guideline. So what they're saying this is going to do is they say it recognizes that rental income received from individuals renting space in borrowers' homes is a stable and viable source of income that increases housing affordability and allows borrowers to better manage housing costs. So does anybody out there think it's a good idea that somebody should be able to buy a house based on not only what their income is, but what they can potentially rent out one of their bedrooms for as well? Does that sound like a good idea? That you need to have a roommate essentially to afford that house, because they're qualifying your income based on as if you had that roommate. Because if you don't have that roommate, then obviously you won't be able to afford the house. Does anybody think that this situation is going to end well? And also, let's not forget about the other aspect of this, that this also brings up a potential for even further abuse of FHA loans. It's already probably one of the most abused type of home loans out there, because people who are investors end up getting these loans and then they do the BRRRR method. If you've never heard of the BRRRR method, it's buy, renovate, rent, and repeat. That's the strategy. So they buy the house, FHA, renovate it while they're living in it, and then you only have to live in it for a year, and then you can rent the house, and then you rinse and repeat and do it again. So it's already a tool that's meant for first-time home buyers or low-income buyers to be able to use, that investors exploit. But now this is going to make it even easier to exploit for more people, because more people are going to be able to qualify to get these loans, when in reality they can't afford the house without a roommate. So one of the main reasons they're looking at doing this is because they know that Gen Z homeowners are going to be next up in line to be borrowing and buying homes, but the reality is many of them can't afford to buy homes without doing some sort of house hacking situation like this. I mean, FHA already made a change to their underwriting in 2023 so that people can use the rental income from ADUs, which is an accessory dwelling unit, meaning if you have a mother-in-law suite or a shed in the backyard that's converted into a bedroom, something like that, you can already use that income towards qualifying for the purchase. But now they're going to make it so you can actually use extra income from an additional room rented in your house. So imagine somebody that buys a single family home that has an ADU in the backyard, and they rent that out, and they rent out one or two of their bedrooms in the house, and they're qualifying based on that income. And what if all that goes away? What if they're a crappy landlord? What if they don't know how to manage their tenants and manage repairs and all the expenses that come up, and they lose their tenants, or people just move out and they can't find somebody else to replace them? And FHA is giving them a loan based on receiving that monthly income. The only safeguard in all of this is, from what I can tell, is they say that the rental income cannot exceed 30% of the borrower's total monthly effective income. But still, 30% of someone's income is significant. That's the entire amount you're supposed to spend on housing. So if you can use 30% of the income from renting out bedrooms to qualify for buying a house, that's a lot. I feel like the real motivation behind this, guys, is because the housing market has been so slow. We haven't seen home sales this low in over 30 years that they're looking at anything they can do right now to get more people into buying homes, because the government benefits from this too, right? So they want people transacting and buying and selling homes. There's taxes that are paid in the form of capital gains taxes, transfer taxes, deed stamps, you name it. Higher property tax reassessments when the property gets transferred to a new owner. All sorts of things happen that are in the government's best interest to make sure that the housing market continues to go around. So making it easier for people to qualify to borrow money seems like a no-brainer for them. The problem is, at the end of the day, these programs are a hazard to society and the people that end up adopting these programs, because they really don't know what they're getting themselves into, just like people who bought these mobile homes 30 years ago that thought that they were going to be able to just live there forever, even though they were paying rent on the land. Another thing I want to cover here is insurance, okay? Because a lot of people are thinking of dropping their insurance due to the high costs, and if you're in a situation where you don't have a mortgage on the house, it's pretty tempting to do it. First of all, if you have a mortgage on your house, you should never try to drop insurance and just see what happens, guys. This is a very bad idea, because the lender is always going to put what's called a forced place insurance policy on the home on your behalf. Okay, and usually it ends up costing way more than the insurance you're already paying, and you have to pay this insurance. And if you don't, then they will begin the foreclosure proceedings on you. So the last thing you want to do is drop insurance if you have a mortgage. But if you do drop your policy, they're supposed to at least give you a 30 to 45 day notice saying, hey, you have about a month to find a new policy before we put this forced place coverage on the home on your behalf. How about this one? Another tear-down house that was purchased back in 2022 for $1.4 million, rebuilt into this monstrosity, listed for $4.6 million, raised the price up to $4.7 million, and now they're down to $4.5 and a half. They just did a $200,000 price cut because they thought it was a good idea to keep raising the price even though nobody was buying the house. And now they're stuck with it. This house is another big brand new house just sitting empty, waiting for somebody to drop $4.5 million like it's nothing here. And this is the kind of house next door, guys. Going back to my video about the mobile home parks and people getting kicked out, this is what's next door to this house. But eventually the entire neighborhood's probably going to look like that. Got one across the street, same deal. Huge house wedged in between two smaller old houses. So right now it's estimated that about 1 to 2% of homeowners actually do have a forced place insurance policy on their home because they dropped their policy. But you don't want one of these forced place policies, because pretty much it protects the lender and not you, because these forced place policies usually just cover the structure. And so say if your house burns down and they rebuild your house after a fire, then you'll get the benefit. But if the insurance company says it's a total loss, then they might just pay off the bank and walk away, which leaves you with nothing. Your contents inside the house aren't insured either. So you get to walk away without not having to pay a mortgage on a house that burned down, but you also lose all of that equity, anything you invested into the house, all of your personal belongings, the whole shebang. But if you decide to cancel your insurance and you have no mortgage, your only real concern moving forward is being able to cover a catastrophic loss like a fire, something like that, for example, where if your house were to burn down or get washed away in a flood or a hurricane or something like that, can you afford to cover that loss is what you need to ask yourself if you're somebody considering self-insuring. According to the Insurance Information Institute, though, the typical home insurance claim for a property is only about $15,000, $16,000. And of course, that's just an average, so that can be a lot higher or a lot lower depending on what happens. So on the other hand, you could look at it as what are the odds of a total loss happening? Probably not very good. And if you want to roll the dice and just have the extra money saved to pay off that $15,000 or $30,000 uninsurable event and it falls on you, then go for it. but you just have to understand that risk. They say the average fire and lightning claim are the most costly claims that usually cost on average about $84,000. So that is a lot of money for some people, right? But if you know you got that money and then some tucked away, then it's probably not going to be a big deal if something like that were to happen. It's going to be inconvenient, but you'll have the money, especially if you're not giving away $5,000, $6,000, $7,000 a year at homeowners insurance. But they say, well, you got to worry about more than just repair costs. You got to think about liability too. They say actually dog liability claims are among the highest average costs of any type of claim filed against homeowners. In 2023, insurers paid out $1.12 billion in dog-related injury claims. Actually, my best friend was part of that statistic as well, because he used to deliver packages for FedEx. And one day, this guy's dog bit him, and it was a pretty bad bite on his arm. He had to go to the hospital, get stitches and shots and all that stuff, and he ended up suing the homeowner and got a settlement for it. Because this guy, it wasn't even the first time that he had this dog out and loose and pretty much didn't do anything to control this dog. And then one day this finally happened and he got a payout. Obviously, the easiest way to prevent this is just not have a dog as a homeowner, and you don't have to worry about that. But still, you could be subject to another liability claim. You know, what if a package delivery person comes to your house in the wintertime and slips on the ice because you didn't shovel the driveway or clear out the ice properly? You know, then that could be a liability claim on you as well. It just really sucks because insurance is one of those things where you are basically rolling the dice just by having insurance, you know? Like just the act of having insurance and paying for insurance is also a risk, because what you're risking is you're paying all these premiums all these years and then risking getting a claim denied or getting severely underpaid, like what happened to all these people with Hurricane Helene and Hurricane Milton, or finding out that you're not covered for an event that happens when you really do end up needing the insurance. Things like that happen to people all the time. Now let's move over to inflation, because we haven't talked about inflation in a while. And Ron Barron, who is the founder of Barron Capital, and he's seen a thing or two when it comes to inflation. And he's been tracking inflation for the past 75 years or so for homes, cars, gasoline, college tuition, steaks, even golf caddy fees, okay? And he's saying that inflation has averaged about 4.5% to 6.5% per year over the past 75 years, okay? But official government statistics say it's only about 3.5% over that time frame. So it's actually closer to double than what the government's actually saying, which lines up pretty well with what we've been talking about here on the channel. And Barron says that the reason why that the numbers for the government are so understated is because of the way that the government calculates inflation. He says that government inflation has what's called a quality adjustment. So a 2024 house, for example, has a lot of advantages over a 1948 house, including things like energy efficient windows, central heating and air, microwaves, and a bunch of other things that weren't available in 1948. Back in 1948, the average annual U.S. household income was $3,200 a year. The home that he grew up in was less than 2 times the average income, okay? But today, the average U.S. home costs more than $400,000, which is 5 times the average household income. And he says, listen, I don't predict anything else besides inflation, and the reality is, everything doubles in price over a span of about 14 or 15 years. And the only real way to hedge against this is to make sure you're continually investing and earning a sizable amount of money on the money that you're investing. It's the only way to keep up, guys. Some people do it through real estate, some people do it through the stock market, some people do it through buying precious metals, some people do all of it. But you have to do something is the point. You cannot just sit by and stick your money under the mattress and hope that in 40 or 50 years you're gonna be able to pull that out and live off of that. It's not gonna work, because inflation will make that money essentially worthless one day. And speaking of inflation, now that inflation has been going in reverse and going the wrong way again, the Fed is now considering scaling back how many interest rate cuts they're going to do over the next year or so. In September, Fed officials, they predicted they would reduce their rates 4 times next year on top of the 3 rate cuts that they were planning this year. But now that outlook is starting to change. And it's funny how they word this, because they say several surprisingly strong economic reports have led to a decidedly more cautious tone from the Fed. Like, yeah, that's what it is. It's because the economy is doing so well. That's why we're not going to cut rates. No, it's because inflation's going back up. So you know what that means for all of us, right? It means higher rates for longer. You're not going to see mortgage rates coming down anytime soon. You're not going to see the credit card borrowing interest rates come down anytime soon. You're not going to see lower rates for car loans anytime soon. Jerome Powell said a few weeks back that the economy is not sending any signals that we need to be in a hurry to lower rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully. But I've said this before and I'll say it again, why mess with it, right? If things are going so great, and you don't see anything to worry about, there's no flashing warning signs in the economy, then why mess with the rates at all? Why did they start lowering them? If everything was fine and there's no problems, why lower the rates? Because clearly the bond market disagrees with that decision. That's why we've seen the 10-year Treasury continue to climb and mortgage rates go back up over 7% again. So nobody actually believes that what the Fed is saying is true. And some people are even saying, well, the economy might even accelerate in 2025. And it's like, yeah, well, if that happens, it's going to be because the Fed continues to lower rates and makes the cost of borrowing even cheaper. But along with that more robust economy will come more inflation, guys, which is going to make everything more expensive once again. Bank of America, they're predicting that inflation is going to be stuck above 2.5%, even though the Fed's targeting 2%. They're just not going to be able to get it there. And all the predictions are showing that inflation is going to continue rising now throughout the end of the year. And they say, well, this isn't anything to worry about, because really what's happening here is a few parts of the economy have experienced more inflation lately. You know, the biggest one has been in transportation costs, such as auto insurance, car repair, plane tickets. Also, you have rents and home prices that are rising faster than usual and haven't slowed down as much as expected. But other than that, everything's great. I mean, transportation and housing are two things that people need the most. The only thing that's not on that list is food. Food prices have already skyrocketed and now have kind of stabilized, but I guarantee you when the first of the year comes and you go to the grocery store, you're going to see prices for everything get jacked up again. That's what happens every year. Economists, they say this is nothing to worry about. This is just what we call base effects. And what that means is the yearly rate of inflation is calculated by averaging the increase in prices over the last 12 months. And whenever a new month of inflation data is reported, the oldest month in the equation drops out. So they say, for example, if the PCE inflation index rises on average 0.2% a month in the final 3 months of 2024, the yearly rate of inflation is bound to increase as the low readings from the last year drop out. Well, that makes perfect sense, but the problem is it still means inflation is going up. It's not like this is some kind of magic trick to show that everything is stabilized and fine. No, if you're seeing prices go up, that means prices are going up. There's no two ways about it. And to make my final point with inflation, just take a look at a couple of these graphs I have here. Core inflation has been rising back up since July. Okay, it's higher than it's been since July of 2024. The October reading was at 3.3%. Then we have the CPI. Okay, all items are at 2.6% right now. And all items less food and energy, it's at 3.3%. So once again, removing the most valuable things that humans need. But then look at this third graph here. When we look at the energy portion of this, that's negative 4.9%. So that is what's driving down these inflation readings, and they're kind of artificially low because energy prices are artificially low. But people need to understand that once energy prices bounce back to where they were, then inflation is going to come roaring back even more than it is now. And this is not a theory, guys. This is not a matter of if, but when. Because one thing that the Biden administration was doing over these past few months is suppressing oil prices to help Kamala Harris get reelected. And that didn't work. But those suppressions are going to run out soon, and when they do, oil prices and the cost of energy is going to go back up, which is going to cause inflation on all these other items to go back up as well. So just get ready for that, because going into 2025, we are going to be in for a rough year when it comes to price increases. Generally, companies and vendors, they raise all their prices starting the first of the year anyways to try and account for future inflation as an unknown amount. So we already see price increases even in normal years. So get ready for everything to be a lot more expensive in about a month from now. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.